Will investing in the ICICI Proof Protect and Gain plan help you achieve your long-term objectives and build wealth in the long run? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand a few basic details about it. So this is a non-participating linked individual savings life insurance plan. Some of the key features of the policy are: you can secure your family's future with life insurance coverage. You can select from 2 plan options tailored to your life stage and needs, and you can build wealth with market-linked returns, and you can also enhance your coverage with 2 rider options, and you have access to 4 investment strategies and get to choose from 22 fund options, and you also get to earn a maturity booster as a reward for staying invested until the policy matures, and you also get to receive regular monthly payouts for additional income through the systematic withdrawal plan SWP, and you also enjoy potential tax benefits on premiums and payouts as per the current tax laws. And there are benefits like death benefit and maturity benefit, and there are fund options like Focus 50 Fund, India Growth Fund, Opportunities Fund, Value Enhancer Fund, Multi-Cap Growth Fund, Blue Chip Fund, Maximizer V Fund, Maximize India Fund, Multi-Cap Balance Fund, Active Asset Allocation Balance Fund, Secure Opportunities Fund, Income Fund, Money Market Fund, Balanced Advantage Fund, Sustainable Equity Fund, Mid-Cap Fund, Mid-Cap Hybrid Growth Fund, Constant Maturity Fund, Mid-Cap Index Fund, Mid-Cap 150 Momentum 50 Index Fund, Multi-Cap 50 25 Index Fund, and Mid-Small Cap 400 Index Fund, Mid-Small Cap 400 Momentum Quality 100 Index Fund, and Small Cap 250 Momentum Quality 100 Index Fund. So these are all the fund options that you get to invest in this policy, and there are also various investment strategies and various charges you need to pay also under this policy. If you want to know more about these aspects in detail in this policy, you can refer to the policy brochure. Now let's take a look at the advantages and disadvantages of investing in this policy. First, start with the advantages. So the advantages are: your premium allocation charge and mortality charges are refunded. A maturity booster is added as extra units at the end of the policy term to enhance your fund value. You have the option to receive the maturity benefit as structured payouts or an income stream for up to 5 years post maturity, and you also get to invest additional funds through a top-up premium, and there are partial withdrawals permitted after the lock-in period ends, and you can modify the premium payment frequency, and there are benefits you can protect under the Married Women's Protection Act, safeguarding them from legal attachment by the court. The disadvantages, however, are: there is a 5-year lock-in period for surrenders or partial withdrawals, and this plan does not offer a loan facility, and the minimum policy term is 30 years. The fund options lack uniqueness with overlapping investment strategies, and the net premium is also invested only after deducting the various charges. So these are some drawbacks that you need to keep in your mind before deciding to invest in this policy. As we have a basic understanding of this policy, let us move on to the analysis part of the video, where we are going to conduct an internal rate of return analysis of the benefit illustration provided in the policy brochure. So we are going to calculate the IRR of this policy now. So for calculation purpose, let us assume that a 30-year-old male opts for this policy with a sum assured of 1 crore. The annual premium is 80,000 with a policy term of 40 years and a premium paying term of 10 years. So the returns in this example are calculated at a future assumed rate of return of 4% and 8% per annum. These are just for example purpose to indicate a worst and best case scenario of this policy. They are not guaranteed in any way, and nor are they the maximum or minimum returns you might receive, because the fund value of the policy will be influenced by various factors including the future investment performance. So this is just for example purpose. If all your premiums are paid as a policyholder, then the fund value will be paid out as a maturity benefit at an assumed rate of 4%, which is the worst case scenario. Your fund value would be 28 lakhs with an IRR of 3.58% as per the policy's maturity calculator. And here at an assumed rate of 8%, which can be considered as the best case scenario, the fund value would be 82.08 lakhs with an IRR of 6.73% as per the policy's maturity calculator. However, the potential returns from this policy are lower than those of traditional debt instruments. So this undermines the purpose of investing in a market-linked product, ultimately slowing down your wealth accumulation process or potentially resulting in a shortfall. Because long investment should outpace inflation. However, this policy with a policy term of 30 to 40 years fails to deliver inflation beating returns. So in the next part of the video, we are going to explore better alternatives where we could generate higher returns by investing the same premium but investing it separately in insurance and investment instead of investing in both in a single policy. So this is an alternative strategy we are going to explore now and do a comparative analysis. So for life insurance purpose, we have opted for a pure term life insurance policy with a sum assured of 1 crore, which would cost us 30,800 rupees per year. So with a policy term of 40 years and a premium paying term of 10 years, this leaves us with 49,200 rupees from the original premium amount we had for ICICI policy, which can be invested separately to generate higher returns. So choosing the right investment avenue based on your risk tolerance is crucial, because if you are a high risk investor, you may prefer equity, but if you're a low risk investor, you may opt for debt. In this case, in this example, we have selected an ELSS fund which is also market linked for a more fair comparison, just to see whether it could give us better risk adjusted returns for a long term period. At the end of 40 years, the ELSS fund here grows to 2.89 crores. So after accounting for the capital gains tax, the post-tax value stands at 2.54 crores, yielding a post-tax IRR return of 10.12%. If you have any doubts regarding how the ELSS tax is calculated, you can see that we have presented a small tabular column on the screen for your reference, which you can pause and see. So here in this alternative strategy is clearly shown that combining investment and insurance is not the ideal, because the two key benefits of this approach, like alternative approach, are the better returns. You get better alpha generation and also liquidity. These two factors are missing in the ICICI Prove, Protect and Gain plan. Then what is the final verdict on this policy? Is investing in the ICICI Prove, Protect and Gain plan worth or not? So with this policy, you pay premiums for a limited period of time while receiving life cover for the entire policy term. However, only a portion of your premium is invested in the market, and that too after several charges are deducted. So at maturity, you receive the fund value. However, as the name suggests, the plan fails to deliver both protection and gain, which is the growth. So the potential returns of this policy are not justifiable given the risk involved, and it also has a high agent commission. Additionally, the policy's long-term nature, requiring a minimum term of 30 years, offers returns that are not proportionate to the risk. One key reason for these lower returns is the high charges. Combining investment and insurance in one plan doesn't help you achieve either goal effectively. Instead, opt for a pure term insurance plan to ensure life cover, which provides financial protection for your family at an affordable cost. For wealth accumulation, it is better to build a diversified investment portfolio.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.